Welcome back. So when we jump into the exciting world of startups, dreaming of innovation growth, but right at the foundation, even before all that, there's this really crucial decision: how to structure your business. This doesn't sound like the flashiest topic, maybe, but our source today, Derek Booker's Credit Mastery for Personal and Business Growth, actually calls it the $1,000,000 decision.
Exactly. It sounds dramatic, but it really can be. And in this deep dive, we're zeroing in on Chapter 12 of Credit Mastery. We're going to unpack why this initial choice, say, between an LLC and a corporation carries, so much weight.
Right.
It's really about understanding how it sets the stage for your business's ability to build credit and, maybe most importantly, how it safeguards your personal financial world.
Yeah, Credit Mastery is all about empowering you financially, isn't it? And this chapter really hammers home that very first pivotal step. It's kind of amazing how the structure you pick right at the start can ripple out like that. Okay, so the chapter lays out these core differences: LLCs, corporations. Let's get into the main advantages, maybe.
Yeah, let's do that. What's fascinating is the fundamental trade-off you're looking at here. So first up, the limited liability company, or LLC. The big win here is right there in the name: limited liability.
Okay.
Think of it like a shield, right, for your personal assets, your house, your car, protecting them if the business runs into debt.
Like a wall between your business and personal finances.
Exactly like that. It offers a significant sense of security when you're taking those big entrepreneurial leaps. And the book notes, they also give you a good deal of flexibility: how you manage things, structure the business itself.
That security feeling, knowing your personal life isn't automatically on the line if the business hits a rough patch. Yeah, that's huge for peace of mind, I'd imagine.
Absolutely. Peace of mind is key.
Now, okay, on the flip side, we have corporations, specifically C Corp, which the chapter also digs into. What's the main draw there, even though that often seem, more complex, more rules?
Well, if you're thinking bigger picture, like serious growth, the main advantage of a C corporation often boils down to attracting investment.
The money.
Right. Corporations can issue stock. You're essentially selling little pieces of ownership in your company to investors for funding. That structure is just much more appealing to, say, venture capitalists, other big investors who want that direct stake in the business's potential success.
Correct.
And that access to potentially larger amounts of capital, that can really fuel ambitious growth plans.
Got it. So LLCs give you that personal safety net flexibility. A C Corp gets really interesting if you're aiming high, thinking about big investments, and okay with navigating a more complex setup. Now, the source also spends quite a bit of time on the tax and credit sides of this, right? It's not just legal stuff.
Absolutely critical. And this leads to that key question: how does your choice impact taxes and, maybe even more vital for future growth, building business credit? For LLCs, the book explains they're generally seen as pass-through entities for tax purposes.
Pass-through, what does that mean exactly?
It means the business's profits and losses essentially just flow directly onto your personal tax return. Like, they pass through the business to you.
Okay. Simpler, maybe?
It can be simpler, especially initially, but as your business gets bigger, this structure might limit your ability to build a truly separate, independent business credit history.
So in that case, the business's creditworthiness could be kind of tied up with your own personal credit score.
That's a really key distinction, yeah. Now let's look at C corporations, because they are recognized as separate legal entities, completely separate.
Right.
They also file and pay their own taxes, separately from the owners.
Totally distinct.
Totally distinct. And it's this separation that allows them to establish their own independent business credit profile. The business builds its own credit history, completely walled off from your personal credit. And the source really underscores this, that separation is vital for long-term financial health, for expansion opportunities. It lets the business stand on its own two financial feet,
That really clarifies it. You're essentially building a whole separate financial asset, the business's creditworthiness, that isn't tangled up with your personal finances.
Okay.
Now, the chapter also brings up this concept, the 90-day startup protocol. What's the core idea there?
Right. The 90-day startup protocol. As Credit Mastery lays it out, it's all about being proactive, establishing your business's creditworthiness right from the get-go, like immediately after you form the entity. Don't wait.
Okay, so what does that involve?
It's about putting those fundamental pieces in place. Getting an employer identification number, an EIN, from the IRS. Think of it like a social security number just for your business.
Right, the business's ID.
Exactly. Then, opening dedicated business bank accounts, crucial separation again. And making sure your business gets registered with the major business credit bureaus, like Dun & Bradstreet, Experian Business, from day one.
So it's basically saying, don't wait until you desperately need a loan to start thinking about business credit.
Precisely.
You lay the groundwork right away.
You got it. It sends this clear signal to lenders, suppliers, everyone, that you are operating as a legitimate, standalone business, that you're serious about building a solid credit reputation. Taking these steps early, it can have a really significant positive impact down the road. Access to capital, better credit terms.
And I guess this links directly to what the source talks about with the investor lens, doesn't it? How do investors and lenders actually see these different structures when they're deciding whether to give you money?
Yeah, it's fascinating how the structure itself speaks volumes to potential investors, potential lenders. They often view a well-established corporation as, well, potentially more stable, more mature.
Especially for bigger investments.
Especially when they're considering putting in larger amounts of capital, yes. And the fact that a corporation can issue stock, that provides a really clear mechanism for investors to get involved, to share in the potential upside.
Right, they see how they get their return.
Exactly. So choosing that corporate structure, if it fits your goals, can often make your business look more attractive. It might open the door to more substantial funding opportunities compared to, say, an LLC in some cases.
Okay, that makes sense. So if your sights are set really high, significant growth, needing outside investment, that C Corp structure might give you a real edge. But the chapter is very clear, isn't it? There's no single best answer that fits everyone.
Precisely. The book really emphasizes this, the ideal choice. It truly depends on your specific situation, your unique context.
So what factors then?
Well, it boils down to a few key things. What are your ultimate goals for the business? Where do you see it in 5-10 years? What's your personal comfort level with risk? How much protection do you feel you need? And of course, what are your actual plans for growth and expansion? What works perfectly for, maybe, a small local shop might be completely wrong for a high-growth tech startup chasing venture capital.
So it really forces you, the business owner, to step back, think strategically about the future, about priorities.
Exactly right. And that brings us nicely to some key takeaways for you, the listener. First off, this decision about your business entity. It is not just some bureaucratic paperwork, it's fundamental. It has significant long-term consequences for your business's credit potential and, crucially, for your personal financial security.
Right. We talked about LLCs, that critical protection they offer for your personal assets, your house, your car. And that operational flexibility, too. That's a huge plus for many new entrepreneurs, isn't it?
Definitely. A very popular choice for a reason. And then on the other hand, you have corporations. Maybe more complex, yes, but they can open up these greater avenues for raising capital, building that completely separate business credit history. That can be incredibly valuable if you're looking to scale up significantly.
And getting your head around the tax implications is vital. That pass-through thing with LLCs versus the separate taxation for corporations, you absolutely have to understand that for a smart financial plan.
Couldn't agree more. And furthermore, that 90-day startup protocol idea, it just highlights how important it is to be proactive right from the very beginning. Establish your business as credible. Start building that business credit profile immediately. Don't delay.
Yeah, don't wait until you need it. And keeping that investor lens in mind, just thinking about how potential lenders and investors might view your structure, that's crucial if you think you might need external funding later on.
Absolutely. But ultimately, as Credit Mastery really stresses, there is no one-size-fits-all solution here. The right choice is the one that aligns most closely with your unique business goals, your growth plans, and your tolerance for risk.
So wrapping it all up, the business entity you choose is much, much more than just a legal checkbox. It is truly a foundational decision, one that will significantly shape your business's entire financial future.
Well said. And with that thought in mind, here's something to consider. As you think about your own ambitions for your business, whatever they may be, and that fundamental need to protect what you've personally built, what type of business entity honestly feels like the most strategic fit for you right now at this stage? And maybe, whether you're just starting out or you've been running for a while, what initial steps could you take to establish, or maybe even just review, that critical foundation?
Some really valuable questions to mull over there. And if you do want to dig even deeper into this, definitely check out Chapter 12 of Derek Booker's Credit Mastery for Personal and Business Growth. It lays it all out.
Yeah, it's a great resource. And, while we focus today on just choosing the entity, the book obviously goes on to talk about what comes next. How to actually build a strong business credit profile once you've got that structure in place. That's sort of the next piece of the puzzle.
Definitely something to keep in mind for future steps. Well, thanks for tuning into this deep dive, everyone. We really hope this has given you a clear perspective on this $1 million decision.